Is it uncharitable to be investing? There's two different arguments that are really laid out here. First is that if you're selling an investment, it's because you think it's going to go lower. And the second argument is that welcome to the Your Life podcast, where we talk about how to integrate the virtues into our life and our finances. My name is Anthony Delazari, Associate Investment Advisor.
Sean Gregory, Portfolio Manager.
AJ Sanson, Associate Investment Advisor.
We are with Serve Him Capital at I Private Wealth, and our goal is to serve you so that your finances may serve your goals and your goals may serve the good. Perfect. All right. Sean, do you want to...
Yeah, Anthony, what are we talking about today?
You had posed the question, is it uncharitable to be investing? Because, and then, okay, let me see if I can articulate these arguments properly. So there's two different arguments that are really laid out here. First is that if you're selling an investment, it's because you think it's going to go lower. So it's uncharitable because you're giving this bad thing to somebody and they're going to be buying it. And the second argument is that it's uncharitable to buy something because you think is undervalued. Yeah, they think is undervalued because then it's going to go up in value, and then you're not paying the fair price.
The argument is it's uncharitable because you're buying it for less than it's worth. So you're doing that person you're buying it from a disservice, an uncharitable disservice.
Yeah. So refute it. Let's hear it.
Well, okay. So there's a lot that goes into when we buy or sell anything, but let's talk about securities.
Yeah, things that you are purchasing for the intent of making money from.
Yeah.
Or making a return on, yeah.
Yeah. So from my point of view, as a professional investor, before we even get to addressing that specific question, like those specific circumstances, I would say that there are many more reasons why people buy or sell a security before you even get to that point. So I think we can first talk about what is obviously not uncharitable. And that's when somebody is making an investment or selling to take their money out of an investment and they have no opinion on the underlying security. And that's someone who, I have savings, I'm putting it away for tomorrow, I'm going to invest this, and I'm just going to put it in the market, or I'm going to give it to my investor and he's going to invest it for me. Or conversely, the person who says, I need money today, I'm in retirement or whatever, and I have all these investments and I just need to take money out. So I don't even know what I'm selling. I don't even care. I need money. So if you're not even making that deliberation that this thing is going to go lower and I'm going to sell it, or this thing is cheap and it's going to go higher and I'm going to buy it from someone else, you're not even making that consideration. How could it be uncharitable is the first thing I would say. And that circumstance applies to most people, most of the time, in my experience, for clients that we work with, or most people who are not actively engaged in markets on a daily basis, they don't really have an opinion on the underlying securities. They think, I'm saving for tomorrow, or I've been saving, so I need to take my money out. And those two people, they're making an exchange in time horizons, right? They're doing each other a favor. Even if they buy and sell to each other, they both come out ahead. It's win-win. Do you have any comments on that circumstance, AJ?
I think it's just basically the timeline of the necessity of these monies with the intent for the future, but sometimes things happen along the way in which you need it sooner. So it's an exchange of, hey, because I need this money now, I'm selling it at this particular price, and so it's a fair exchange.
Right. Yeah, I think to a degree it's actually almost good that we have markets that are liquid, so that you're able to get
accessibility.
Realization.
It's not only is it not uncharitable, it's a good thing.
Yeah.
Like these people have both benefited from it.
Yeah, because otherwise you're just losing money to inflation.
Right.
Yeah.
Also think of the other extreme. Sorry.
Yeah.
It's like there's certain investments that have challenging liquidity.
Yeah.
And when an emergency event comes up where you need access to these monies, that's also an injustice, because if that mechanism for being able to sell out of whim based on need doesn't exist.
Yeah, and then you can be taken advantage of in that scenario.
Right, yeah, it's a fire sale, it's hard to find a buyer.
And so someone will take advantage of you in that circumstance.
Yeah, so we just concluded that the markets are actually a very charitable way of exchanging money.
I agree. I'm totally biased. Okay, so I would say with confidence that circumstance is, in my mind, clearly not uncharitable. But I can also paint a picture of the circumstances by which buying and selling securities is obviously uncharitable. And that's when you know for certain, or with an extremely high degree of certainty, that what you are selling actually is going to go down.
Yeah.
Or what you are buying actually is extremely undervalued. And the way that that can happen is that you have information that other people don't have access to. Not only is this uncharitable, it's so uncharitable, it's illegal.
Yeah.
And we call it insider trading, right? And it's not just unfair, it's actually theft. You're stealing from the person you're buying or selling
you're
from.
exploiting
Yeah.
someone.
Yeah.
Yeah.
So we could say with confidence that clearly is uncharitable.
Yeah.
Agreed.
Now, what about the times when, okay, you are operating with the same information as the person on the other side of the trade? What are the circumstances, Anthony, would you say, in our experience, managing portfolios for clients, what are the circumstances that we make trades, that we buy and sell securities?
Well, yeah, we never look at, is this going to go down or is it going to go up? We look at, is it going to be better then? So it's always relative. So if we have an opinion of a security that we think is going to do well, it's because we think it's going to do better than something that we're holding, because we only have so many positions that we have. And so we'd sell something that we don't think is going to do as well as another security that we think is going to do better. But that's not uncharitable. That's just our opinion because we have a certain return target that we're trying to hit. On the flip side of that, it can actually be better for somebody to sell out of something that they think has more risk and buy something that actually has lower risk. So somebody who's on the opposite side of that transaction from us, in no way could it be charitable. It could just be, hey, we think there's more potential in this area. And we can be totally wrong. We're not assuming infallibility when we do that because we know that we are fallible. I think the argument from being uncharitable when you're trading is that if you assume that you are infallible, which you don't have to do, or I don't think many people do when they are making these trades. We just make it on a not to stress out clients, but like a best guess.
Right. Well, it's the future. The future's uncertain for most of us, and so we are making a best guess, absolutely. Yeah. But that circumstance you described, we have a portfolio with a set of companies, and we're always scrounging for ideas, and we find an idea we really like.
Yeah.
So we have to make room for it by selling something. It doesn't mean that what we're selling we think is a terrible company or it's going to go down. It just means we find an idea we like more.
Yeah.
So it doesn't have that intrinsic, I'm selling because this is going to go lower and I'm doing this other person disservice.
Yeah.
How I process that is its efficiency of managing risk appropriately.
So that's the next one, risk management, right? But it's different than I like this idea more. You could say to yourself, with this set of companies that I own, I'm exposed to this one risk in a more significant way than I would like.
Right.
Therefore, I should reduce my exposure to that risk by exiting this company, that company. Meanwhile, someone else on the other side of the trade says, I have no exposure to this risk or and opportunity that comes along with it. I would like to add exposure to that in some way. And so you can make an exchange of risk with someone else. Similar along the same vein is this idea of diversification. A lot of the time that we are in that first circumstance where I find a new idea I like a lot, we're going to add to the portfolio, and then we look at it and we say, well, it's kind of like a puzzle that no longer fits together. This other name here, here, and here, well, they're really similar to this new idea. And so perhaps I should make some changes in that vein. There's a third circumstance, which is rebalancing. We had an initial opinion on a company or security. We thought it was going to do very well. We were correct. It did very well. And the natural course of an investment that goes up a lot is it becomes a bigger and bigger part of your portfolio. And you can still like the company. You can still have a high conviction in the idea. But very often we will sell some of it because we don't want to own too much of it.
And it sounds like that would be the prudent thing to do, is to scale back as well to manage that risk.
Mm-hmm. So I don't think though either any of those circumstances they don't have that internal thought process of this is going to go down, so I'm going to sell it before it goes down, or this is going to go up, so I'm going to sort of steal it from someone who doesn't realize this. Yeah.
I think part of that too has to do with your mentality going into it.
Mm-hmm.
What is your end goal and what is your
What's your intention?
Exactly.
I think more often what happens is that you own a company, bad news happens, the shares fall significantly, and then you sell it.
Yeah.
Because your initial hypothesis, you realize this is incorrect, or whatever happens to be, you change your opinion. Usually it falls first, and then you sell it.
Mm-hmm.
And the person on the other side of that trade is thinking, this thing just fell by a significant margin. I think it's on sale. That happens not uncommonly.
Yeah.
But I think there are times where we will make changes to a portfolio in anticipation that I think this thing is expensive. It's gone too far. I would expect it to not continue to perform well, or even for it to go down.
Yeah.
That does happen.
Yeah.
Did you have a thought there?
No, not really. No.
Okay.
But yeah.
But I was going to say, so the reason that I don't think even that is uncharitable is because if we're all working from the same set of basic facts,
yeah.
the only difference is our interpretation of those basic facts. And for people who are active in the markets, they understand that very often we are wrong.
Hmm.
Very often we are making assumptions about the future that we think about probabilistically. And so we think, this company's gone up, it's really expensive. I assign a probability of 60 or 70% that it's going to go lower because it's gone too far. Someone on the other side of that you're selling it to, they could look at the same facts and interpret it differently.
Yeah. Or they can say, I'm fine with only like a 40% chance.
And that's the other thing too,
Yeah.
is that they can understand, look, I think there's a 20% chance it goes up, but if it goes up, it's going to go significantly,
Yeah.
or it meets my own return target.
Yeah.
So we have different desires to take on certain risks and opportunities in different ways. We interpret the same facts differently, but one person thinks it's to their benefit, whereas we may think it's to our disadvantage. But then there are the times that I'm interpreting facts differently from someone else, that I appreciate the fact that they are doing something different, like interpreting it differently. And I don't think it's doing a disservice to that person.
Well, in what you had shared, I think of the risk-reward context. So some people are willing to anticipate different risks, different rewards, and we don't have perfect knowledge, and it's our assessment of that information that is publicly known where we make our own assessments. And sometimes we get it right, sometimes we get it wrong. And someone could be on the other flip side of that, as you had mentioned.
The last thing I'll say about this is that this does not apply to all markets of all things that you can buy or sell. It applies to the equity market. It's not a zero-sum game. It's not that my gain is someone else's loss or vice versa. The average gain of all investors is the market return, and the market return on average is positive. So that if you make a good decision, using the benefit of hindsight, you had an above average return, but the person that you sold that other security to, they may have had a below average return, but it was likely still positive just on the statistics of the numbers. And your above average return is more likely a reflection that you took on more risk to earn that return,
Yeah.
a risk that you were comfortable wanting to take. And someone else's below average return was their conservatism, but that fit their investor profile. That fit what they were trying to do, their goal and their objective. And you knew that in order to attempt to earn this above average return, you had to take above average risk to do it. But you were comfortable doing that. So I think I would not characterize that as uncharitable.
Yeah. Oh, yeah, I'm on the same page. Brilliant.
Sounds good.
All right. Thank you for listening. I'm Anthony.
I'm Sean.
I'm AJ.
This podcast has been prepared by Sean Gregory, who is a portfolio manager, AJ Sanson, and Anthony De Lazari, who are associate investment advisors for IA Private Wealth Inc. Opinions expressed in this podcast are those of the portfolio manager and investment advisors only, and do not necessarily reflect those of IA Private Wealth Inc. IA Private Wealth Inc. is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. IA Private Wealth is a trademark and business name under which IA Private Wealth Inc. operates.